Return on equity is a really important concept that I learned about a few years ago when I actually bought my first rental property. So I bought my first rental property. I said, I'm getting these awesome cash on cash returns. I only put down something like $7,000 to buy it. And I'm making $500 a month. So I said, I am blowing it out of the water. That's as close as you're going to get to 100% cash on cash returns. I think that's something like 80% cash on cash returns, which sounds amazing. You get good bragging rights when you're talking to other real estate investors. You're saying, wow, I'm making 80% cash on cash returns. But I was only making $500 a month. And where I started to really think about things differently was when I looked at the equity I had in the property. So I bought it for $7,000 down. I put I put another 10,000 or something into it. So you add it up, I think I was making 30% cash on cash returns all in, which is still really, really good. I'll take that any day. But let's say I was making 30% cash on cash returns after the rehab. I got lucky and a hailstorm came through and replaced all the exterior of the home. So the home was worth quite a bit more than what I bought it for. I bought it for 182,000 and then it was worth 330,000 suddenly after I did a little work and I lucked out and a hailstorm came through. I said, wow, I'm making this 30% cash on cash return, but I have so much equity that's kind of trapped in the house. So I looked at it and said, okay, if I if I look at my return on how much equity I have in the house, I was making something like a 2% cash on cash return. Really bad. Or return on equity, rather. So that's really bad. Now, there's a few ways that you can get this return on equity better. You can do what I did, which was sell the property and do a 1031 exchange. You can refinance the property so you get to keep the property. You get to pull a lot of equity out of the property and use that for other investments. So if you can keep that money moving and compounding, you're obviously going to make a lot more than if it's just stuck in that property. Or you could pull a line of credit on the property and use that for other investments. There's not a wrong way to do this. So what I did was, because I wanted all of it, not just 80% of the equity in it, I wanted to take all the equity out. I sold the property. Now, if you go and you refinance and pull it out, they're only going to go up to 75% of loan to value on a multifamily property. In some cases, you can get up to 80% with a local bank. You're probably going to have trouble getting higher than that, and you're going to need a loan that's has creative terms, but it's probably a riskier loan. With a line of credit, they're probably in the similar ballpark. It might be 80%, maybe 85% if you're really lucky. So if you're at a 50% loan to value, they'll only go up to 80 or 85. So you got to figure out what works for you. In my case, it was selling the property. But when I'm evaluating return on equity, I'm making sure that I'm hitting my return goals on all the equity I have. And this is harder than it sounds. So if I've got, like I said, I had 130,000 or 140,000 of equity in that property. It was making me a 2% return. I could do better than that in the stock market. So I needed to pull that money out and put it to work again on another property that's going to make me more than I can get if I have a risk-free return with like a savings account or a bond, or if I put it into any other investment, stocks, real estate, crypto, whatever it is. I think it's important to always evaluate what your equity is doing for you, because if you can continually compound that equity, you're going to do a lot better than just sitting on the equity and watching the equity build. Nothing's gained until you actually pull it out. So it's great to have all that equity in a property. It's really not doing anything for you there unless you sell, refinance, or pull a line of credit.